The situation, I'll put it this way, feels fluid. I'm being diplomatic. What does it mean for some parts of the commodity market versus, say, others?
Well, John, thanks for having me again in the program. I'll tell you, it's very confusing. We've seen a big impact on the prices of regional commodity differentials. We saw it last week, prices of Canadian gas versus U.S. gas, Canadian crude oil versus U.S. crude oil. We are seeing it today with the prices of regional aluminum and steel premium and in the U.S. But also we are seeing the effects on the term structure of commodity markets because as these tariffs get applied, you don't know exactly when they're going to be applied. So people are trying to rush the commodity in. So you're getting that if you like, that mini spike up the front, hoping that maybe you can squeeze a little more product in before the tariff hits. So it's impacting really regional differentials. It's impacting the term structure of the price, spot versus forward. And of course, some of these measures are being announced in the morning and taken back in the evening. So we are a little concerned that there might end up being some negative economic effect because of all this uncertainty. But certainly, as I pointed out, I mean, this is really a negotiation tactic, and that's, I think, what the market believes. But also, as you pointed out, some of these tariffs, they get put on and they just stick around for a while.
They stick around for a while, which means what potentially could happen to trade flows? Are you already seeing trade flows around the world start to shift?
Well, the reality of the matter is, in the last trade war we had in 2018-19, we ended up seeing some damage to global PMIs, right? And ultimately, of course, we ended up with COVID in 2020, so everything became very distorted. But we had a pretty strong cyclical backdrop in 17-18 when all this tariffs started, when trade war started. So we are a little concerned about the negative effects. Remember, at the end of the day, a tariff is a tax, and when you put a tax, that tax needs to be split between the importer and the clients of the importer, and maybe some of it gets washed out in the FX. But I mean, to give you an example, if you're a U.S. industrial that's buying aluminum, you're gonna have to find a way to pass that through, and most likely that's going to impact your margins as an industrial producer. And America, buys some raw materials, but also produces advanced manufacturing. And now the question is how deep does that supply chain go? Do you have the tariffs just on the aluminum or also on the aluminum product? And remember, last week, some of the most vocal voices against tariffs came from the U.S. refining industry. They said, "Oh, we buy all this cheap Canadian crude oil, cheap natural gas from Canada, and we turn it into amazing products like gasoline and diesel that are top of the line." And that's one of the reasons the U.S. refining sector is so competitive. The tariffs would have really hurt that, right? So you have to be careful. You never know where things are going to come from, and it's really one of the challenges that we are seeing across the board.
I'm glad you brought up 2018 because that's when the U.S. hit nearly $7 billion of European steel and aluminum exports with duties. This was under Trump's first administration. And then, of course, we had this retaliation from Europe on things like Harley-Davidson motorcycles. What kind of retaliation can we expect this time around?
Well, I think one of the big challenges that Europe has is obviously Europe, to your point, has a trade surplus with the U.S. But there's also a large services deficit on many areas, right? So there's sort of talk about tech potentially being involved as a retaliatory sector. We could see some retaliation, but I think importantly, the European industry is not in great shape. You're looking at very high domestic energy prices as a result of the Russia-Ukraine war, cutting off supplies of energy, pipeline gas into Europe. You're seeing also weak demand for European products in China, which of course has a domestic demand problem that's fed on into the European industry. So I'm not sure Europe is in a great position from an industrial standpoint to cope with rising tariffs from the U.S. So it's a frail moment for Europe. Growth is barely scratching 1%. Germany's been in pretty much recession for 3 years running, and now we're seeing natural gas prices spiking again in the past few days, right? So it's a tough combination. I think Europe is a tough spot. But of course, if the Russia-Ukraine war ends, I think things will ease, right? So that's perhaps the big hope, is that we're going to see the end of the Russia-Ukraine war.
Francisco, that's a muddle of uncertainty. What's your highest conviction amid a muddle of uncertainty at a time where one of these tariffs, if they go through, could be inflationary or deflationary if it really suppresses growth?
Well, so for us, one clear winning area has been the precious metals complex. So we've been very bullish on gold and silver. We have a $3,000 target for gold, which today we scratched 2,900. Silver, we believe it goes $35 an ounce. And so we see that as a winning area within the commodity space. Continued diversification from central banks, but also investor portfolios. Oil, a little more range bound. Difficult to call here between this barrage of tariffs, but also sanctions, right? Sanctions on Russian energy on the way out by Secretary Yellen. And then there is the discussion around Iran, what happens to Iran. So to us, the cyclical commodity complex is really on the edge with PMIs around 50. And so the clear trends are like I said, in the precious metals and perhaps in some of the softs and the meats. The grains market also complicated to call here with forecasts shifting quickly and suddenly adding to upside pressures on a market that was on a downward trend for a while.
Francisco, can we finish on energy? I think we're used to, historically, people like me at least, being long the whole complex at the same time. Within energy, you're starting to notice dispersion, reasons to be bullish some parts and bearish others.
Right. No, we do. And certainly, I think we've been more bearish crude oil this year. It hasn't played out that way. I think the tariffs on Russia the sanctions on Russia were quite unexpected. They distorted some of the volumes and therefore created tightness in the market that probably reduced the surplus that we were projecting. So now we're more neutral. We think oil is going to be averaging, Brent's going to be averaging 75 and 71, 72 for WTI. So we see a more range-bound market. But yeah, the energy complex is vulnerable to cyclical demand conditions, and it's also, frankly, vulnerable to OPEC restarting or bringing production back in April, right? So we'll see if OPEC does that. But at the same time, you got other factors, like I mentioned, on Russia sanctions and potentially Iran maximum pressure, which has been shelved for now, but could come back, right? So energy is a little more complex. There is plenty of spare capacity, so people are not truly worried. But at the same time, there's low inventories, and that keeps the market in a range, in that kind of $70, $80 range environment with the curve in backwardation. So that's the backdrop in energy. Natural gas more complicated. We see strong demand for power, driving gas in the U.S., in Europe, elsewhere. And we have a tight market for power. So it's electrons versus molecules here.